When I first started trading, I heard someone say, be careful because we have data coming up in a few minutes. And I had no idea what they were talking about or why we should even care. But then the data came out and the market reacted almost instantly. And that's when I learned the chart isn't the only thing that can move your trade. Because some factors, they're scheduled ahead of time, and then others, they can hit while you're already in position. So let's start by looking at some of the ones that you can see coming in advance. So when traders talk about data coming out, they usually mean a scheduled economic report. And a few names you're going to hear over and over again. CPI measures changes in the prices that consumers pay, and it's one of the main reports traders watch for inflation. And then there's PCE that also measures consumer inflation, and it's the measure that the Federal Reserve uses for its inflation goal, though it watches like CPI and other data as well. Then you have PPI, and that tracks price changes but from the producer side. You also have the jobs report that gives the market information about employment and unemployment. Then you have FOMC meetings, and those are where the Federal Reserve makes their interest rate decisions, and they also give updates on monetary policy. That one's important, so make sure you start that one. But you don't need to become an expert on every number inside of these reports. You can just start by recognizing the major names and then knowing when they're scheduled. So probably the easiest way to do this is with an economic calendar. For economic data, you can use free calendars on MarketWatch or investing.com or even TradingView. But if you're trading individual stocks, another thing you need to stay aware of are earnings dates, because earnings can send the stock sharply higher or lower. And that's including when the market is closed, because most of them report either after market close or before market opens. And to find those, you can check your broker app. You can check the company's investor relations page or an earnings calendar on something like MarketWatch or NASDAQ. And then another really cool resource that a lot of people use is Earnings Whisper. They have a popular weekly graphic, and it shows many of the major companies that are reporting that week, and they put that out every week. And I believe you can sign up for that for free. Now, on big market data days, the market can start reacting differently before the major report even comes out because they know it's coming. Some traders may wait before taking bigger positions, especially when the release is later on in the day. And that could leave the market slow. It could be choppy or full of moves that don't hold. It could be all over the place. A breakout may start, then fail, and then snap right back into the same range. And the thing is, it won't happen every time, but if you see the market and it feels like it's suddenly very indecisive, you might have some type of market data on the calendar, and that'll explain why. Now, after the report comes out, price can move super quickly. It can jump, it can reverse, it could break through levels, it could trigger stops before you even have much time to react. And the spreads can widen, and a market order that you thought would feel for a much better price, it can feel for a much worse price than you expect. In other cases, data will drop and then everybody expects this big move and barely anything happens at all. You just can't know ahead of time like what's going to happen exactly. But what you can do is you can educate yourself on when an event is coming that day. And then if you trade options, that adds a whole nother layer of things to worry about because if traders are expecting more volatility, options, as we know, can get more expensive. And once the event passes, some of that extra pricing can disappear just as fast as it came. So even if you get your direction right, the option may not gain as much as you expected. That's extra risk you may not see coming on your technical analysis or on your chart alone. Then there are some market movers that aren't scheduled at all. An economic calendar can warn you about reports, it can warn you about earnings, but it can't warn you about every headline, like unexpected company news that just drops out of nowhere, good or bad, or maybe geopolitical developments or war, things like that, or maybe policy announcements, or a social media post from a very influential figure that just happens to drop the post while you're in a trade. Those moves are a lot harder to prepare for, but that's where your position sizing becomes very important because the larger the position, the more damage one surprise can do before you have any time to react to it. So what can we do? Well, once you know it's coming, you can decide then how you want to handle it. You can wait until the event passes, you can trade smaller, or you can stay in the trade and accept the added risk. There isn't one choice that works for every trader or even for every setup. Just make sure you make the choice so that the market doesn't make the choice for you.